Hi, I'm Josh Brown. With me, as always, Michael Batnick. Today, we're going to play our favorite game, What Are Your Thoughts? I don't know what Michael's going to ask me, and he doesn't know what I'm going to ask him. Stick around. Let's see what's going on. All right, Michael, you're going to start things off for us today, I think, right?
I am.
Okay,
Josh.
what do you got?
What are your thoughts on the recent washout in stocks?
In stock? Well, I think one of the things that I thought was striking was that it's been led by technology stocks, or maybe it hasn't been, but those are the stocks that everyone pays attention to. And then and that made no sense to me. But what did make a lot of sense was that the really ugly action was taking place in home builders. And you would think rates mortgage rates going up, it should constrain enthusiasm for that group of stocks.
Wait, why does tech going down not make sense to you? What would make sense to you?
Well, tech going down the most, I think, made no sense to me because of all of the publicly traded.
They've gone up. They've gone up the most.
Yeah, but I don't know if that means anything.
Can it just be that simple?
Yeah, but they've gone up the most because they probably need the least out of cyclical growth globally to do what they're trying to do. They had this secular growth underpinning to the earnings over the last few years that didn't seem to be changed from 1.5% GDP growth in 2015 to 4% GDP growth this year. It seems like these companies were just ticking regardless.
So what are your thoughts?
My thoughts are this is what markets are supposed to do. Not every stock is supposed to go up at the same time, and people are supposed to periodically rethink their expectations and make changes to their holdings, and this is what should be expected. I think it's totally reasonable action. All right, let me get into this conversation with you. I have attempted over the last week and a half to find some literature or data to support this, and I can't, which means it's probably bullshit. But I was thinking that higher rates should be better for value stocks. And value stocks, of course, have been in a bear market versus growth for a long time. So on an absolute basis, they've been okay, but growth has just dominated. Value stocks should do better with higher rates because when money gets more expensive, it should favor incumbents versus new companies that are running equity-financed business models can just come in and start disrupting things, giving things away for free, etc. So I asked everyone. I can't find any data to support it. Should I just take this theory and throw it out the window, or what are your thoughts on that?
Well, when you said this, I thought it made sense just intuitively that the incumbents, I guess the value or stocks, General Electric, maybe that's a bad example, but those would do better in late cycle.
Like a bank versus a FinTech company.
Right.
The FinTech company raises equity capital. The backers have no expectation to make any kind of money anytime soon. That makes sense when rates are zero. Money's free. Throw spaghetti at the wall. Now money costs something. You have to pay to borrow. Are you going to fund those types of business models the way that you were? Probably not. So my theory was value should get a tailwind versus growth, but maybe it doesn't. Anyway, that was my best guess. What do you got?
Is there a lull in TV? Like, what are you watching?
Well, I mean, a lull, you can watch a whole season in one day. So, I don't know. I watched Ozark like you did. It was probably the last thing I fell in love with, second season. Mm-hmm. Now I feel like is the fall. It should be like prime time for all these new great shows.
Do you watch This Is Us?
No. You know what I watched? The reboot of Magnum PI. And
What?
So you're younger than me. I grew up in the early '80s when I was like a very little kid, and my parents would let me stay up to watch Magnum PI, and it was Tom Selleck.
Okay, I was gonna say Burt Reynolds, but
No,
I knew there was a mustache, an '80s mustache.
There was a mustache and a Ferrari and two Doberman Pinschers, and it was just an awesome.
So how bad was
detective
how
show.
bad was the reboot?
It took place in Hawaii. No, I liked it. I liked the reboot. I hope they keep paying for it and making new episodes. I don't watch anything on network TV, but I feel like you can do that now. You can just reboot shows. You don't even have to bring it back the old cast. You just need the name.
Did you watch Karate Kid?
No.
Me either.
What, the movie?
They did a reboot.
Yeah,
supposed to be good.
Yeah, I didn't hate. Oh, is that the one with Will Smith's kid? The Karate Kid with Will Smith's son?
That was like 15 years ago.
So what are you talking about?
They did a show on YouTube, I think.
Oh, yeah. No, I didn't watch that.
All right.
It looks stupid. I want to ask you about FinTech as a distraction. So I feel like we love FinTech, and we probably, what do we use, 10 different types of software for all different functions?
We just had Rob Koifin in here from Koifin.
Yeah, like people are making cool stuff.
Yeah.
And we always see it like relatively early because, not because we're anything special, but I think people look at our following on social and they say, if I can get these guys interested in it, maybe that's a good toehold, which is fine. We're fine with that. But I feel like a lot of FinTech, especially wealth FinTech, at this point is just becoming a distraction from what real advice. Like real advice is a client, an advisor on the phone or in a room talking about life, and then walking out of that room and making financial decisions based on that conversation. How much software is really necessary, like at this stage in the game, to be able to say, I'm giving it, like how many layers of things do you need between yourself and the client?
All right, well,
what are your thoughts on that?
This is 2 times now that you just made a statement.
Well, it's just a question.
The statement was finished,
Okay.
and then you asked for my thoughts.
I want your thoughts.
I agree.
Okay. You agree that it's too much?
You said it all.
Well, can I ask you this then? How do you know when it's too much? You have to wait for the client to tell you, hey, I don't want to do all this. I just want to talk to you?
I don't know.
I'm glad I got to ask you that.
So
to you.
the 10-year went from a low of 1.37% in July 2016 up to 3.2% today.
Yeah.
Thoughts?
Well, back to what we said earlier, I do think when money gets more expensive, people make, I don't want to say better decisions, but maybe people think twice. The carry is the carry, right? Thoughts about, does it affect a portfolio? I think it's great. I think clients can now have a position in short-term treasuries or T-bills or money market funds, and it's not costing them money to be there, even on a real basis, right? Like if CPI is 2.8 and you're earning 3.2 in a treasury, like it's not killing you. So what are your thoughts on it?
What are your thoughts?
But that's as far as I get.
I like beer.
Do you have a rate prediction that you want to unveil today?
We closed about 3.2% 2 days in a row. That's the trigger.
Is that what Jeff Gunlock said?
He said something like that. Maybe it was on the 30-year. I don't remember.
What does he mean? What is it the trigger for?
I have no idea.
Like the end of the bull market?
I don't know.
All right. We'll put a pin in that. I was looking at headlines today that...
Wait, you looking at what?
I was looking at headlines today
that
Kanye West is going to go visit the White House and talk to Donald Trump. And my initial... So this is what I want to know from you.
Is this 3 times in a row now? You're going to tell me what you think?
No, my initial reaction was, LOL, so stupid, everything's stupid. But then I read, he wants to talk about how to fix the problems in Chicago, where he comes from.
I just stop. My turn. So Tim Buckley was at the Boglehead conference this week.
Yeah.
And a lot of talk on social media about Vanguard indexing or indexizing financial advisors.
Yeah.
You must have some thoughts.
So what were his exact comments that the portion of the investment cost to investors that goes toward advice is going to go lower?
He's going to drive down financial advisor fees the same way that Bogle did with index funds.
Oh, I think he probably will. That doesn't mean they go to zero, but I do think that there are 11,000 RIAs in America. Most of them don't have a reason. Like if you ask them, why do you exist? What do you do that's different from everyone else? Why do you need to? I don't think that most of them could justify why they're here. So I've been on the record saying I don't think this is a 1% business anymore. I think it's trending toward a 50 basis point business, and that'll be great for clients. But that requires scale if you're going to be a practitioner. So I think Buckley's right.
Is that 3 years? Is that 10 years?
No, it's probably 10 or 15 years. And the reason why I say that is if you think about what people are paying right now for financial advice, forget about the 15 people you talk to on Twitter who are living 3 years in the future from reality. Twitter is not real. It's not the real world. Think about the thousands and thousands of people offering financial advice on a transactional basis at an insurance company. You might say, oh, those are dinosaurs. Well, guess what? the most amount of financial advisors in the industry come from the insurance channel, more than wirehouses. I don't know if you knew that.
I did not know that.
Okay. That all-in cost for financial advice from the insurance channel is like fucking 4%.
Hold on. By the way, I'm going to need see some data on that.
I'll give it to you.
Okay.
I have it from Chip Rome at Tiburon. I was floored when I saw that. So that's so...
I'm going to need to see his data.
So when you say an advisor charging 75 basis points for hours of their time throughout the course of each month, that's where the fat is going to be cut out, I totally disagree. It's going to come from channels where people are paying... They don't even know what they're paying because they don't even get performance reports. They literally get brokerage statements that are unreadable. You ever get a brokerage statement from a brokerage account? It's like, here are your holdings. Here are the dividends that were paid this month.
I mean, we see them all the time, hundreds of pages.
Yeah. There's no cost broken down in there.
Right.
There's not even performance.
Right.
Like, that is the part that Vanguard is just going to beat the crap out of. And they should. I hope they do. So I think there will be less RIAs, but the RIAs that exist are going to be gigantic. And then the other thing that I think is worth thinking about, and this is new.
What do you mean new? Like you haven't told me yet?
I haven't told you yet, and I'm just formulating this in my mind, but it's coming from a lot of places.
This is going to be ugly.
Breaking news. I think asset managers are worried about their funds and SMAs being disintermediated by technology. Like, I think asset managers are not up at night thinking about fees for active because all the big ones aren't active anymore. All the big asset managers, the $1 trillion names, are all passive anyway. I think they worry, what if advisors one day don't need funds because using the blockchain or something, they're able to do the same strategy and it costs them $0.
A scalding hot take. All right.
So I think it's great if Buckley's able to succeed. There's a ton of fat in the industry. Most of it is not on the RIA financial planning side, although our side will have to consolidate, and I think that's great too. So I don't have any more for you. Do you have any more for me?
I do.
All right. What do you got?
Bitcoin has been at $6,000 for like what seems like a century.
It's resting.
Does it want higher or lower?
It wants higher.
I think it wants lower.
No, I think we've seen the worst we're going to see for Bitcoin. I think the crypto world, everyone I talk to, I mean, it's a joke that I have a forecast for this, but just play along. Everyone I talk to is now a Bitcoin maximalist. No one's talking about other coins.
Well, honestly, I have no idea what you're talking about. What is a Bitcoin maximalist?
A Bitcoin maximalist is a philosophy. It's somebody that says...
All right, we're gonna end it there.
No, let me get this out. You asked. A Bitcoin maximalist is someone who says... Every hour spent and every dollar spent on an alternate coin is a joke and a waste of time. The only way crypto assets are going to become a mainstream asset is if the smartest people devote all their energy to fixing the three biggest problems. Transactions are ludicrous. Custody is the Wild West. And image, meaning there's not enough real institutional money. So I actually think now the world is coming around to Bitcoin maximalism, ignoring all the other nonsense tokens. And the signal from Yale last week, people are saying that's the bottom, where arguably the most storied endowment fund in the history of endowment funds is now funding a crypto asset hedge fund.
Now, hold on. So that hedge fund is $400 million.
Yeah, it's tiny.
They're putting a piece of money into that. So even if it was the full 400, it's less than 1% of Yale's assets.
But how much money is in Bitcoin? It's tiny.
No.
Anyway.
But I would say, but that doesn't matter because what does matter is the signal that it sends.
So that's my only point.
Right.
I'm not saying like David Swenson called the bottom
All
of
in.
Bitcoin. Yeah, no. I do think it's meaningful when he does something versus if you told me Princeton did it.
Right.
Or MIT. Like, obviously MIT. I think David Swenson, who was a pioneer in private equity investing, in venture investing, he was way ahead of his time in all of these. And if the whole thing goes to zero, it wouldn't affect his reputation at all. So why wouldn't he?
Right, yeah.
So that's where I am. Anyway, thank you for watching. If you have any comments on any of the topics we discussed today, tell us below. We love our comments, and we will be back soon.